As we approach the end of 2025, many people are looking at the price of gold. It has captured headlines. The shiny metal has climbed above $4,500 an ounce, marking a significant record for the year. When prices move this dramatically, it is natural for people to feel a mix of excitement and anxiety. They start asking themselves questions. Should I sell what I have and take the profit? Should I hold on, hoping it goes even higher? Or is now the time to buy more before I miss out completely? These are important questions, but they should not be answered in a hurry. A fast decision is often the wrong decision, especially when it comes to your hard-earned money and long-term financial security. The reasons for this surge are not a mystery. A confluence of global events has pushed investors toward the perceived safety of gold. We have seen persistent geopolitical tensions in several parts of the world, which always makes people nervous. When uncertainty rises, many seek tangible assets. At the same time, central banks, particularly in emerging economies, have been buying gold in large quantities to diversify their reserves away from the US dollar. Add to this the recent cuts in interest rates by major financial institutions. Lower rates make holding non-yielding assets like gold more attractive compared to bonds. Finally, we have seen significant inflows into gold-backed exchange-traded funds, showing that individual investors are also joining in. Of course, we have seen this story before. Gold has had powerful rallies in the past, such as in the late 1970s, and again after the 2008 financial crisis. History teaches us a valuable lesson. What goes up very fast can also come down. These parabolic rises are often followed by significant pullbacks or long periods of stagnation. This doesn't mean gold is a bad investment. It simply means that chasing performance is a dangerous game. Buying something only because its price has gone up is speculation, not investing. A true investor buys an asset based on its intrinsic value and its role within a broader, well-thought-out plan for the future. Therefore, the current price of over $4,500 should be viewed with a calm and steady perspective. It is a data point, not a command to act. The headlines will shout about new records and potential riches, but the wise investor tunes out the noise. Instead of getting swept up in the excitement, now is the time to step back and look at your own financial situation. The key is not to react to the market's temperature, but to act according to your own long-term principles. The price of gold today is less important than the reason you own it in the first place, and that reason should not change day to day. In investing, your greatest enemy is often yourself. The human mind is not always well suited for making rational financial decisions, especially when markets are volatile. Two powerful emotions, fear and greed, tend to take over. When gold's price soars, the fear of missing out, or FOMO, becomes incredibly strong. You see others celebrating their gains, and you feel an urgent need to jump in, lest you be left behind. This is a recipe for buying high, often at the very peak of the market, just before a correction. It is an emotional reaction, not a calculated one, and it rarely ends well for those who succumb to it. The opposite emotion is just as dangerous. When the price inevitably pulls back, panic can set in. The same person who bought at the top out of greed may then sell at a loss out of fear, convinced the price will go to zero. This cycle of buying high and selling low is what destroys wealth over time. The news headlines will fan these emotional flames, both on the way up and on the way down. They profit from clicks and views, which are driven by sensationalism. But your financial plan should not be dictated by a headline designed to provoke a reaction. True financial discipline is about sticking to your plan, regardless of the market's daily mood swings. I have often said that it is wise for investors to be fearful when others are greedy, and greedy when others are fearful. This is not about market timing, it is about discipline. It means you should be most cautious when everyone is euphoric, and most open to opportunities when everyone is panicking. When an asset like gold is hitting record highs, and is the talk of every financial news show, that is a time for caution, not unbridled enthusiasm. It is the time to review your principles, not abandon them. The best investors make a plan and stick with it through thick and thin, making minor adjustments, but never letting emotions steer the ship. Discipline is the bridge between your financial goals and their accomplishment. It means doing the boring but effective things, like regularly reviewing your portfolio and rebalancing when necessary. It means not checking the price of your holdings every single day. An asset you plan to hold for decades should not cause you daily stress. If you find yourself constantly worrying about the price of gold, it may mean you own too much of it, or you bought it for the wrong reasons. A sound investment strategy should let you sleep well at night, confident that your plan is built on a solid foundation of reason, not the shifting sands of market sentiment. So, how much gold should a prudent investor own? There is no single answer that fits everyone, but a simple guideline I find useful is what we can call the 5-10-15 rule. This is not a rigid command, but a framework to help you think about asset allocation. It ties your gold holdings to your comfort level with risk and your view of its role in your portfolio. The rule suggests that a conservative investor might allocate around 5% of their portfolio to gold. A moderate investor could aim for 10%, while a more concerned or aggressive investor, perhaps someone very worried about currency debasement, might go as high as 15%. Let's break this down with practical examples. Imagine you are a conservative investor, perhaps nearing retirement. You value stability and capital preservation above all else. In this case, a 5% allocation to gold makes sense. It is enough to provide a hedge against inflation or a major market downturn without exposing your portfolio to too much of gold's volatility. If your total investment portfolio is $500,000, this would mean holding about $25,000 in gold. This small allocation acts as a safety net, a form of financial insurance that you hope you never have to use but are glad to have. It will not make you rich, but it can help protect what you have already built. Now consider a moderate investor in their 40s, with a longer time horizon. They are comfortable with a bit more risk for potentially higher returns, but still want downside protection. For them, a 10% allocation could be appropriate. This provides a more meaningful hedge, and if gold performs well over the long term, it will have a more noticeable positive impact on their overall portfolio returns. For the same $500,000 portfolio, this would be a $50,000 position. This is a substantial holding that reflects a belief in gold's long-term store of value, balanced against a larger allocation to productive assets like stocks and businesses that generate earnings and dividends. Finally, what about the 15% allocation? This is for someone who is particularly concerned about systemic risks, things like runaway inflation, major currency devaluations, or significant geopolitical instability. Allocating 15% of your portfolio to gold is a strong defensive stance. However, it comes with an opportunity cost. That 15% is not invested in businesses that are growing and creating value. For our investor with a $500,000 portfolio, this would mean holding $75,000 in gold. This level should be chosen with care, as it represents a significant bet against the stability of the broader financial system. It is a position for those who prioritize wealth preservation above all else. With the 5-10-15 rule as our guide, we can now answer the question of whether to sell, hold, or buy. Your decision should have nothing to do with the headlines and everything to do with your predetermined allocation. If you find that the recent price surge has pushed your gold holdings far above your target, for example, you aimed for 10%, but it has now grown to 20% of your portfolio, it is logical to sell some and rebalance. This is not market timing, it is disciplined portfolio management. You are taking profits and reallocating them to underweight assets, sticking to your original plan. What if you check your portfolio and find your gold allocation is right where you want it to be? Perhaps you targeted 10%, and after the price run-up, it is sitting at 11%. In this case, the best course of action is often to do nothing. Simply hold your position. You own gold for the long term, as a hedge. It is doing its job. There is no need to react to every price movement. An investor's portfolio is like a bar of soap. The more you handle it, the smaller it gets. Resisting the urge to constantly tinker is a key to long-term success. Let your plan work for you without unnecessary interference based on short-term news. Finally, there is the scenario where you might buy more. This should only be considered if you are underallocated according to your own long-term plan. For example, if you decided a 5% allocation was right for you, but you currently own no gold, it is reasonable to start building a position. However, you should not rush to buy your full allocation at a record-high price. A prudent approach would be to dollar-cost average into the position over several months or even a year. This methodical approach reduces the risk of buying at a temporary peak and smooths out your entry price over time, reinforcing the discipline that is so crucial. In closing, it is essential to remember what gold is and what it is not. Gold is not a productive asset. It does not produce earnings, pay dividends, or manufacture anything. Its value comes from its scarcity, its history, and its role as a store of value when people lose faith in other assets. Think of it as financial insurance for your portfolio. You buy homeowners insurance hoping you never have a fire, and you own gold hoping for a stable and prosperous economy. It is there for protection in a worst-case scenario. Do not mistake an insurance policy for a lottery ticket. Stay disciplined, diversify your investments broadly, and learn to ignore the noise. Your future self will thank you for it.